Founders, welcome back. Today in this video, we will be learning about capitalization table, popularly known as cap table. We will be learning exactly what it is and how to create a cap table for your startup. It is a really important document, and for any stage of fundraising, be it angel round, seed round or VC, series A, B, investors are going to ask it and will go through it. And I have seen startups losing chance to raise funds just because they are not ready with their cap table. Almost a year back, a startup from Dehradun, an edtech company, was unable to raise because they were not able to produce cap table when the investor asked, as they were unaware that investors are going to ask this also. And when they went back to the investors with the cap table, it was almost a week's time. By that time, the investor gave soft commitment to another startup in the same domain. So not having a cap table handy at the time of fundraising for the investors is almost like pitching without a pitch deck. Before we will start with this video, a disclaimer. As it is a complicated topic and I need to give an example to make you understand about cap table or capitalization table. So I will be taking some names. Names of VC firms, name of angel investors, even name of companies. All these names, whichever I will be taking, are imaginary. Don't connect it to any existing VCs, investors or company out there. What we see before Hindi movies, इस कहानी के सभी पात्र काल्पनिक हैं. इनका जीवित या मृत्यु व्यक्ति और संस्था विशेष से कोई भी संबंध नहीं है. As I am clear with the disclaimer, so now let's start. Capitalization table or cap table. For many entrepreneurs, especially the first-time founders, raising outside capital can be daunting. Between all of the new vocabulary like term sheet, capitalization table, pro rata, and different valuation metrics, and the very real legal implications of the agreements being signed, it's really easy to get overwhelmed. When you are first starting out or just need a refresher, it's often best to learn from the examples. So that's what we are going to do today. We are going to try and explain the basic mechanics of first round of funding, some of the key terms involved, and how different type of financial instruments and deal structure work. So let's start a company and build the capitalization table. And for the sake of keeping this accessible, we are going to try to keep the terms simple. So let's start with founding a new company. At the beginning, imagine two founders. Let's take it Sivesh, that is me, and Ayush, who is the operations associate with Startup Monk. So we got the founding team. Now, the idea, or rather say their idea. Let's take an example, say Internet of Wings, a chicken restaurant featuring drone delivery to all of Delhi and beyond. So the founding team of Sivesh and Ayush reach out to a CA or say lawyer to set up a company. The two decide to split their stakes at a 60-40 ratio, with the majority going to Sivesh because he is going to serve as CEO and has the technical background to make the scalable part of the drone-based delivery into a reality. They also decided to set apart 20% of the shares into the equity pool for the future employees. So here's how the ownership stakes break down at the start. 48% to Sivesh, 32% to Ayush, and the rest 20% for an employee pool. So Internet of Wings Private Limited, abbreviated like IOW, like IoT, Internet of Things, but involving poultry, was established as a private limited company, the standard type of legal entity for venture-backed startup. Here is something which you need to understand, that when you are going for fundraising, you need to have a private limited company. People who have company registered as proprietorship or OPC, that is one person company, or LLP or partnership firms, they don't get funds that easily. Or I can say that out of 100, 99% of times they are not going to get funds. So you need to have a private limited company to raise funds because this is the only type of legal entity in which investors put money. Okay, so now let's get back to the Internet of Wings. So Sivesh and Ayush get the company registered as Internet of Wings with an equity distribution of 42%, 38% and 20% as employee option pool, with 10 million shares of common stocks outstanding, issued at a par value of $0.001 per share. With this, in the eyes of the law, the company is now valued at 10K dollars or $10,000. Let's make the capitalization table for the company at this point. Okay guys, now let's see how capitalization table made at the founding. If you can see the Excel sheet which is there on the screen, as we discussed at the start or at the founding, there are 3 shareholders into the entire cap table. First is Sivesh, second is Ayush, who are like founders and co-founder, and then the third is the employee stock options. That is the option pool for the employees. So first section will be shareholders, second will be the percentage shares. So as we have already seen, the distribution of stakes is 60-40 between Sivesh and Ayush. Further, they have decided to keep 20% aside for the employees. So after deduction of 20% from the stakes, the distribution of stakes further as 60 and 40 will be 48% and 32%, which you can see in the second part, that is percentage under the percentage stake. 48% to Sivesh, 32% for Ayush and 20% for the option pool. The third is the number of shares. At the time of the registration of the company, they have allocated total of 10 million shares. So when we calculate the number of shares as per the percentage of each shareholders, it is coming out to be 4,800,000, 3,200,000 and 2 million as per the shareholders equity into the company as of now. The fourth is the price section, which is 0.001, which we have already decided, and the fifth part is the values. So when we multiply the price of these stakes with the number of these stakes, the value is going to come. The calculation that is coming into the cap table at the start of the company is number of share 10 million and the total valuation 10,000K. So this will be cap table for Internet of Things at the founding. Now Ayush sets to work developing a chicken sandwich that appears to be lovingly handcrafted even when produced at industrial scale, and he may or may not have taken inspiration Apple's patented pizza boxes. Yes, it's another story. In other video, I will take it up. When creating packaging to keep the sandwiches intact and warm, but not soggy, during the soft airlift from Internet of Things rented kitchen space to the customer. Meanwhile, Sivesh hacks together a drone capable of flying chicken sandwiches in every location. After months of working nights and weekends, they go to a park. Their X-Drone Nano 2.0. If you don't know about Nano 2.0, just check it. It is a drone company of India and successfully makes their first flight, which was captured on a video, and in the age of social media, it went viral on YouTube, Facebook, Instagram, Twitter, which demonstrated demand for the novel idea but no cash to cover the costs of the business. Sivesh determines it's time to raise some outside capital in a seed round. Seed rounds come in 2 main flavors: priced and unpriced. A priced seed round is much like any other round of funding in that the company is given a valuation and shares in the company are purchased for cash by investors at a price determined by the valuation. It is the normal process. But today, due to their popularity relative to their price cousins as well as their unique structures and financial instruments, we are going to focus on unpriced seed rounds in this section. As the name suggests, in an unpriced round, the company is not given a valuation and the investor isn't necessarily purchasing a known amount of equity at the time of investment. Rather, it's an agreement between the investor and the company to issue shares in a future priced round in exchange for an infusion of cash at the time the unpriced seed deal is struck. You will find the details of priced round and unpriced round in other videos of Startup Monk, so keep following us. The 2 most common financial instruments used in unpriced seed rounds are convertible notes and simple agreements for future equity, also known as safe note. For more detail on convertible notes and safe notes, check out this section of type of financing into our basic of fundraising course. Now let's get back to Ayush and Sivesh. They decided to raise capital in an unpriced seed round for their startup. They figured out that they will be needing somewhere around $5 million to get their company off the ground. After soliciting introductions from their network and lots of back and forth, they find 2 investors eager to commit the entirety of the round, which means that 2 investors agreed to invest $5 million into the seed round of Internet of Things at unpriced round. So now the name calling starts. Let's say AHA Ventures agrees to a 2.5 million safe notes with a 20% discount provision, and FAR Networks will invest 2.5 million in a safe that has a 10 million valuation cap on the company's pre-money valuation. Agreements are signed, money is wired to the company's bank account, and Ayush and Sivesh resume the process of building their venture. It's important to note that at this time, no new shares has been created and the value of the company remains the same because again, this is an unpriced round where no new value is assigned. Now let's come to the Series A. If you are going to raise a seed round, then the investors of the seed rounds are going to ask you when you are going to raise the second round, that is the Series A round. And generally the time period is anything between 18 months to 2 years. So let's talk about Series A with Internet of Things. Fast forward 18 months. Business is booming with the fleet of drones buzzing all around Delhi NCR area delivering chicken sandwiches to hungry customers. Sivesh and Ayush have mastered the financial resources from their seed round well, having invested heavily in R&D, a few good engineering hires, and a few agreements with drone manufacturers overseas. But despite rapid growth, the company isn't profitable and is remained with a runway of only 8 months. That is, after 8 more months of operations, the money will dry out. It's time to raise Series A round. If a company hasn't already raised a priced round, Series A is typically when the shares of the startup receive their first valuation. Amongst venture capitalists and other startup investors, it's common to hear two types of valuations. That is the pre-money valuation and the post-money valuation. We have separate video where we have discussed in detail about pre-money valuation and post-money valuation. Put simply, a pre-money valuation is the value of the company prior to the round's infusion of capital. The post-money valuation, on the other hand, is the value of the company after the round is completed, and it's usually calculated by adding the amount of money raised in the round to the pre-money valuation. So the deal, Ayush and Sivesh went to Bangalore to raise their Series A. They want to raise 7 million. They meet with many investors and ultimately work out a deal with two new firms. One of the previous investors, say Fard Network, opted to participate in the round. Now here's the breakdown. Startup Future Fund will lead the round by investing $4 million. SoftBank is participating with its investment of $2 million. Fard Network rounds out the round with $1 million. Analysts at Startup Future Fund determine the Internet of Things is worth $15 million prior to the investment. This is its pre-money valuation. Although it is tempting to think that the company's post-money valuation will be $22 million, that is $15 million plus $7 million that they raise, we will see the post-money valuation is actually a bit higher due to the discount and cap provision used by the seed investors. The final signing of the checks and legal paperwork sets off a cascade of conversations and capitalization table adjustments as the company issues new share to its investors. Now let's see how the new cap table will be. Let's start with our seed investors whose investment will be turned into equity at this stage. Our venture invested with $2.5 million in a safe with the ability to purchase shares at a 20% discount to the pre-money valuation at Series A. The Series A price is $1.5 per share, $15 million pre-money valuation divided by 10 million shares. The number of shares originally created when the firm was incorporated, which we noted earlier. So at a 20% discount, $1.2 per share, our Ventures 2.5 million investment converts to 2,083,333 shares. That is 2.5 million divided by $1.2 per share, valued at 3.125 million, a 1.25x multiple on invested capital. In the seed round, Fard Network also invested 2.5 million in the safe notes with a valuation cap of $10 million. This allowed them to purchase shares at $1 per share. That is 10 million cap divided by 10 million shares, resulting in purchase of 2.5 million shares from their seed investment. At the new 1.5 share price, Fard Network seed investment is now valued at $3.75 million, a 1.5x multiple of the initial investment. Now the Series A investors. At a Series A stock price of $1.5, Startup Future Funds purchased 2,666,666 shares with its 4 million investment. SoftBank purchased 1,333,333 shares with its 2 million investment, and with its 1 million follow-up funding In the Series A round, Fard Network purchases an additional 666,666 shares of a series stock. So here's how the ownership of the companies break down after the Series A round. Let's start first with our capitalization table. After the Series A, funding round is complete. So you can see the post-money valuation of the company Internet of Wings after successfully raising money through Series A round is roughly $28.875 million. Recall our temptation to say post-money valuation should be $22 million. Add $15 million pre-money valuation plus $7 million raised in Series A. Clauses like valuation cap and discounts allow investors to purchase shares at a price lower than the prevailing prices per share. This increases the number of shares they are able to purchase and thus results in more shares being created. Let's think about what would have happened if Internet of Wings seed investors didn't implement caps or discount. They would have been issued stock at a regular share price of $1.5 and accordingly wound up with a smaller percentage of the company. The terms they put into the investment agreements both raised the post-money valuation of the company by generating more shares and served to give investors a larger chunk of company than they would otherwise be entitled to if they purchased the shares at price $1.5. Purchase share at $1.5 share price paid by Series A investors. Here's the percentage breakdown of the company's different share classes between seed and Series A rounds. One of the other important thing to note is that on a percentage basis, Ayush, Sivesh and employee equity pool's relative share of the company has decreased on a percentage basis. This is known as dilution. Financially, dilution isn't really a big deal because even a shrinking slice of the proverbial pie is still valuable if the size of the pie, the value of the company, continues to grow. For example, although holders of the common stock own just 52% of the company after Series A, the collective stake is now valued at $15 million. As long as share prices continue to increase in subsequent rounds, the value of their stocks will continue to increase, even as they continue to be diluted. Asterisk and terms and conditions. Down rounds flip the math here, both diluting current shareholders and driving down the value of their stake. More on that in a coming video. Where dilution does matter, though, is in the control of the voting structure of it. In most voting agreements, voting power is often tied to the number of shares and the type of share one is holding. At times, founders and other investors can find themselves outnumbered during key votes as their percentage ownership of the company is diluted. This is the principal reason why many investors include anti-dilution provisions to maintain their control in the company. So we came to the end of this section, that is the capitalization table. So in this section what we learned, raising outside money is one of the more esoteric aspects of being an entrepreneur. But it doesn't need to be confused. Although we use relatively simpler terms, we discussed the differences between pre-money valuation and post-money valuation, saw how different types of deal term affects valuation and percentage ownership, and explained how raising new rounds of funding can lead to dilution of founders and early investors' stakes in a company over time. Things are often considerably messier in the real world, but the underlying mechanics discussed here still holds. We have shared an Excel sheet template of cap table in the bonus section of the course for the course participants, which they can download and use, as it is a really important document which every investor is going to ask if you are going for this. So let's catch up in the next section. Till then, bye and take care, guys. See you in the next video.